class on how to use fibs or Fibonacci levels or Fibonacci retracements. Now, I'm going to say it again because inevitably, at this point, I start getting messages from the late attendees asking if I could send them a link to the class. So I'll just remind you, as I said earlier, if you use the same link you used to come to this recorded class in 24 hours, you will be able to see a recorded version of this class. In about a week, it should be up on the YouTube chat, the Alvexa YouTube chat, but that just depends on the people who do the editing and the uploading and all that. But you can still use the same link in 24 hours to see a copy of this class. Now, Fibonacci retracement levels are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. Some of the most popular Fibonacci retracements are 61.8, 38.2. Now, you can round them off to 38 and 62 because because they are not exact numbers. If you try to use a fib level, just like a support and resistance, they are areas, they're zones, they're about a price that will be significant. So you can round them out easy to 62 or 38. But the Fibonacci retracement tool already does it at the exact number. Okay. Now included in there is 50%. 50% retracement has nothing to do with Fibonacci levels, nothing to do with Fibonacci. It just is in trading. The 50% level is so structurally important that it's been added into the fib levels. And I'll explain that to you in a minute. Now, David wrote in saying the links do not work, asking me tomorrow to go send the links to 800 people. David, let me answer you first. I'm an outside educator. I've got nothing to do with the internals. So if you say the links don't work, I don't know how you'd say that because tomorrow it will work. It should work. But if it doesn't, please contact your account manager and ask them to supply you with a proper working link. Now, these fib levels or Fibonacci retracement levels are very, very important to our trading. Okay. But Fibonacci has nothing to do with online trading. Online trading didn't even exist in the 16 or 1700 or the 11th century when the Fibonacci numbers were developed or located or discovered. Now, somebody told me back in school, and this is a long time ago because I was in school a long time ago, that the basis of Fibonacci levels came from watching rabbits multiply. You start out, you have none. So the first level number in a Fibonacci sequence is 0. You get one rabbit, and what do you got? You had 0, you got 1 now, so you have 1. So the first number is 0, the next number is 1, and the next number is 1 after that. But if you add 1 to that 1, you get 2. So you have 0, 1, 1, 2. But those 2 will now produce another one, so you'll have 3. And those 2 together with the 3 will give you 5. And now you have 3, and those 3 with the 5 will give you 8. You have 8. Add that to the 5 you had before, and you get 13. The Fibonacci levels do not change. The numbers don't change. They go on forever and a day, and they're always the same numbers. But it's not something you ever have to memorize. Believe me, I couldn't even remember 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55. I couldn't go beyond that. It's like in school we learned what pi was. I don't even remember what it is. It's the 0, 3, 1, 6, 4, whatever it is. And we had to remember it in my trigonometry class to 6 digits. After that, I couldn't remember it at all. Now I can. I know what pi is, but I don't even know what the actual number is anymore. But You don't ever have to remember Fibonacci numbers, but you have to understand how the sequence was converted into mathematical properties that now can apply to trading. So keep in mind that sequence of 0, 1, 1, 3, 5, 8. Okay. Now, if we were to take the sum of, or take the numbers next to each other and divide them anywhere in the sequence, anywhere, take one number and take the next number after it and take the one after it and divide it by the previous one, guess what? You'll always get approximately 1.618. If you were to take a sequence, and again, no matter how long it is, and take a number and take two numbers away from it and divide it into each other, you'll always get 0.618619, about 0.62. If you were to take the same number, say anywhere in the sequence, and take a number and go two places away from it and divide it, you'd always get the 0.382. If you go one more step and take whatever numbers in that sequence and take three places apart, you'd always get 0.236. So this is how the sequence was converted into ratios. So what are the prime numbers in the Fibonacci ratios? Okay. 1.618, 618, 382, 236. And it keeps going on and on and on. However, you can go 1.618 and divide it, and just add on more differences in between. But the funny part is, again, forget about financial applications, forget about online trading. These numbers have been around since the Greek ages. 1.618 refers to the golden ratio, or the golden mean called phi. And the inverse of this is 618. These ratios can be found throughout nature, architecture, art. The proportion of 0.0618 to 1 is a mathematical basis for the shape of playing cards, for the Parthenon, for sunflowers, for the indentations in a snail shell, for Greek vases, actually for the spiral galaxy. I've been told, and I did read it somewhere, that the closer our eyes, ears, and nose fit to the Fibonacci sequence, the more attractive we are to other human beings. Not whether they like blue eyes and green eyes, or light skin or dark skin. These ratios put a proportionate balance in our face, and it's just a proportion that is more attractive to other people. Doesn't mean you're prettier, doesn't mean you got better skin. It's just something about it makes it more proportionate or attractive in human nature. Now, somebody who skipped hundreds of years forward found a way to apply this to the financial markets by observing the markets and the movement in price, the movement in the price charts. We have Elliott, who developed Elliott waves, and we have another guy who developed cycles. We have all kinds of things that have been developed watching price movement on charts. But one of the most important movements we find on charts is that when price is moving up or down, it has a tendency to push up, because price doesn't move. Let me get my marker on here. Price doesn't move like that. Price mostly moves like this. It's a mess all over the place. But when price is trending up, it tends to push to a higher high, ease back down, and then push to a new high, ease back down, because there's a certain momentum. We don't know what starts this momentum. If we could all figure out what starts a trend, we'd all be rich. But there's something that starts a movement. And what happens is buyers start jumping in from the sidelines. This movement starts creating energy and pushing price up. Now, this takes a lot of energy. As price moves, and it's not your trade and my trade. These are the big traders out there. But it's all of us jumping on this bandwagon. As we see price move, well, let me clean up this page here. as we see price move, these guys, the guy who works for the bank that's trading, $1 billion in a euro or whatever he's doing, okay, he doesn't just blindly jump in and hope that the market will take him to this level and let his price trade run into. He opens his trade at this point. He's already set his exit point, and he's happy with that profit in between. Okay. He's not looking for exit strategies and strategies to let it run. He's just made his trade for the day, made his company $1 million for the day. Everybody's happy. Now, he's pushed the price. He did. He saw this trend or this movement or the ability or the possible scenario. And what happened is so did other trades. And this price started to move up. Up, up, up. Now we start noticing the movement in price. Other people start jumping on the bandwagon. As price moves up, it gets to a point where this guy who came in here, his sell order starts to be executed because this is the price you don't know where he put his sell order, but this is the price that him and the other guys got put their sell orders. And as these sell orders blow off the market, the energy starts to subside. And what also happens is these guys like you and me that are sitting on the sidelines that haven't entered the trade start saying that price is too high. We're not going to enter the market. So we've moved to the sidelines. This trade has moved to the sidelines. And what happens is price starts to ease back down. At some point, as price eases back down, people start jumping back into the market and pushing up because it already had energy. It didn't lose its energy here. It just took a breath. Okay, now, by observation, many traders, many professionals, many people for a very, very long time have observed that when price is pushed up and it starts to ease back down, it will ease back maybe or often 38.2% of the movement upward here. But it could retrace to 50% of that movement, or it could go as deep as 61.8. And continue that trend. Okay. It's not a reversal yet. It isn't a done deal. It's not a jump out of the market. But these are levels in which you would want to question. These are also levels that if you were in the market, maybe you want to put your stop loss there. Okay. Or if you weren't in the market and you saw it retrace to 38.2, well, maybe you decide you want to buy, but you're going to see if it comes down to the 50% level. If it hits somewhere around 50 and starts moving back up, that's a trigger for you to maybe think about jumping in the market. 61.8 is said to be the last step on the door. Now, there is one lower level, which is in the 70% range, which is bargain basement. If you start thinking this asset might continue moving up, you might wait to hit the 71.86, whatever that number is, and buy at a bargain basement, completely discount last number on the train thing. Hope you bought it really cheap, and it's going to continue that move up. Now, I can't make you believe in these numbers. I can't make you want to trade from these numbers, but I'm a hardcore support and resistance guy. Okay, hold on. Let's pop up a live chart here. Okay, I trade from price action, support and resistance, a couple trend patterns, a couple candlestick patterns, and volume. That's all I use. Okay, triangles. I'm a big triangle guy. That's it. But that's me. But I firmly believe in my support and resistance levels. Why? Because I've drawn these on my charts. I've done the research. I understand why these levels are important. I've created these levels. I've explained these levels, and nobody else has these levels because they are my personal support and resistance by going back and looking at historic moves on the charts and seeing where the price is hemmed and hawed in the past. Okay. I have a problem personally with indicators and oscillators that are just mathematical formulas that everybody has the same indicator and oscillator with the same action and react. Makes you and me and a million traders around the world the exact same thing. I firmly believe putting the effort into doing your own analysis and figuring out your own important prices is critically important. That's got nothing to do with Fibonacci, because Fibonacci also allows you to set your own levels. Even though we've got these sequences that are preset in stone, it's how we draw our Fibonacci's on our charts. And this is critically important, because to draw a Fibonacci retracement on your charts, you've got to identify the previous high and the previous low. You don't care about where price is going right now. You care about the trend or the movement that is over. Because if you're going to calculate 38.250 or 61.8, you need to calculate on something. It's of the previous move. So in other words, the euro was at $1 and down to 50 cents now. We're down to 50 cents at the end of that move. It fell 50 cents. So when we want to put our fibs on the charts, we want to know where we'll retrace to. And we have to do that based on that fall of 50 cents. And the retracement might be at 50% that, or 25, 38, 38.2, or 61.8. So we do this by finding the significant swing high and swing low. And that's what makes you different than all the other people around you. Okay, so that's what makes it critically unique. Now, a couple people have asked, what time frame do you use for Fibonacci's? You don't use any time frame for Fibonacci's. Fibonacci's are put on the whatever time frame you are using for your analysis. This is not a adjust to fit and find whatever I want to make it find. If you're using, like I use a 30-minute chart and a 1-hour chart. I use a 1 hour for my environmental. I use a 30-minute for making my assessment of the markets and my trading decision. And I use a 5-minute to come up with my entry and exit points. But that's my formula. It's not necessarily yours. So you need to put the Fibonacci's on your chart based on the chart that you would normally be using. Now, because Fibonacci's require the swing low and the swing high of the prior move, that swing low and the swing high is going to be no different if you're using a 30-minute chart or 1-hour chart. That previous trend is what had to end. Okay. So like we're looking at right now, my 30-minute chart. And I already drew these on here for you, or circled them for you a little bit earlier. Okay. Some people might say the swing low is here or here. Other people might say it was here. Okay. This was a movement to here. Okay. To me, we went in sideways congested mess, and this movement is over. Okay. It might have been the one we used to evaluate this uptrend, but that uptrend is also over. We're now in a different direction. Okay. So what do we have to find? We have to identify the swing low for the previous movement. So that would be there and here. But this is where you become different than the next guy. It's determining what it is. Because a lot of people will use the high and a lot of people will use the low. Some people use clusters or a big jump. I say, and this is only my rule to myself, is to find that word, and the word is significant. I didn't add that word. That's always the word for Fibonacci's, is to find a significant swing high and swing low. Okay. I want to find the price point that I can say that price pivoted from that downtrend to an uptrend, or an uptrend to a downtrend. Okay. By finding that correct point, you then will put your Fibonacci retracement tool on your chart more successfully than the next guy, and those numbers will be slightly different. So once we found a significant high and a significant low, we then go to our Fibonacci tool. Where's my Fibonacci? Oh, it's at the top. And we take it and we pull it from that swing high to that swing low. If we were coming off of an uptrend, we would go in one direction. If we were coming off of a downtrend, we do it in the opposite direction. So you have to find a significant swing high and swing low. Then for downtrends, you click on the swing high and drag that cursor to the most recent swing low. For uptrends, you do the opposite. You find the swing low and pull your cursor up to the swing high and then drop it on your charts. Now, let's go. So as you can see, it's beautifully dropped on my charts. Now, because of modern technology, we have the ability to do lots of things. I've got mine color coded. I like colors. I like keys and everything else. Also, Fibonacci's can be used in many cases to go beyond the current time frame. I find them very confusing to have them on my charts when this movement that I'm analyzing is over, because then I would draw new Fibonacci's on the next level. But there's all types of strategies of using two over top of each other, but these are different people's strategies. You'd have to learn them and master them. They're not like support and resistance levels that you should extend into the future, because these price points and these levels are only good for price coming off of this current trend and the movement of this current trend. So it's not like a support and resistance level that is based on a price. This is based on how long this trend is, how much movement there was in that trend. So we can see that right now we're at 1. Okay. Now, remember, we're looking only at here. So if price came back all the way to here, it would have retraced 100% of its movement. Okay. If price came down to this far, it would have retraced 78.6. Here's the 61.8. Here's the 50% line. This is price movement based on the movement upward, how much it's retraced in its movement downward. So we might expect that price would come down here and hit the 38.2 and possibly bounce off and continue on its journey. It didn't do that. In fact, it completely ignored the 38.2. So the next point we might be looking is the 50%. Now, this is a current live chart. It hasn't touched that 50%, but we're hoping if we had bought into this asset and we're holding on our position, okay, I might have set this 50% as my stop loss to get out of the markets. Now we're hoping it bounces off and continues moving up there, but we don't know. This is only a point for us to think about. I have somebody, Jack Parker, wrote in no video. What are you talking about, Jack? Does everybody else out there see my screen? Can you write it into charts? Because if there's an issue seeing my screen, I would like to know. Great. I have a whole bunch of people saying that they can see. Thank you very much. Okay, so if it fell down to 61.8 and bounced off, now I would have been out of the markets. Okay. But if I was sitting on the sidelines, not in the market and thinking about buying into this asset, maybe if I saw it bounce off hard enough off of this, I might consider buying into the market. I'm sorry to interrupt. Jack, I'm sorry, because whatever the issue is your internet and your computer, because I have 150 people writing in here that they see the charts and they're having no problems. So either refresh your computer or check your internet. but everybody's seeing what I'm doing in real time. So sorry, I can't help you, but so now what we've learned how to put the Fibonacci's on our charts. We've learned how to read the price levels. We've learned how to set them up. Again, you can have them not so overbearing. I've set them automatically if you use a Fibonacci. You have the ability to set it in the rainbow. I happen to like the rainbows. You have the ability to set it with no background colors and just have lines. You have the ability to set every which level you would like to see. Okay. And the colors you want those levels. So you decide what best fits on your chart that doesn't drive your eyes crazy. If you don't want a background, you can get rid of it. You just want it in black and white, you can get it in just black and white. Again, it's up to you to select your comfort level. So let's go back to my PowerPoint. And now hopefully you're all seeing my PowerPoint. So as I explained to you, find the swing low, find the swing high. Remember, find the significant swing high or the swing low. And it's the exact opposite in a downtrend. You do the same thing, but it's very, very important to pull your cursor in the right direction because you want your price lines and your numeric values to be done in the right direction. Okay. Because say in a downtrend, 100% retracement would be up here, coming off the downtrend, and it would have retraced this whole prior movement. So in order to apply Fibonacci levels to your chart, you'll need to identify the swing low and the swing highs. When using the Fibonacci tool, the probability of achieving the intended results can increase when used with other support and resistance levels, trend lines, and candlestick patterns for supporting entry and stop loss points. But remember, these levels are alert zones. There's nothing written in stone. And because if you remember when we looked at these Fibonacci sequence in the very beginning converted to the ratio, some calculated 1.612, some calculated 1.619. And then they were averaged out to be 161. They were averaged out to be 38.2. They were averaged out to be 61.8. Okay. So from the very beginning, they were just averaged out. So remember, they're not finite numbers. And they are just zones. They're like something hitting you on the back of the head and saying, hey, look at me. This is a important step on the ladder going up or down as price moves. So if you think of the Fibonacci levels as steps on the ladder, if you're going up that ladder, each one of those steps are significantly important. But you could be jumping down that ladder and jumping, you could be a young guy going down 2 steps at a time or climbing up 2 steps at a time. Okay. But those steps are still there. Those steps are crucial. And the steps are in the same place going up and down, but you have to know which way you're going, because if you went up before, you got to go down now. If you went down before, you have to go up now. So keep that in mind, that the levels, though, are not interchangeable. They're only good for that particular movement and that particular time. So drawing that 61.8 Fibonacci level out into the future doesn't do you any good. Sorry. So keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It is at this point that traders should employ other aspects of chart analysis or technical to identify or confirm reversals. Now, once you know that there's a price point on your chart that will be strategically important, what does that tell you? Keep your eye on that price point. Look for other things. Okay. If I'm sitting on the sidelines thinking about entering and it's come down to 50%, and I'm saying that's a good price, I want to see a reaction in volume. Maybe I want to see it bounce off my support level twice. Maybe I want to see a bullish or bearish engulfing signal. Maybe I want to see an indecision candle forming right on that fib level. Okay, you have to make your decision, your trading strategy, what you're going to look for. But when you have important numbers in this journey, like if you're climbing up and down that ladder and the lights go out, as long as you know where that next step is, what to be prepared for, you're okay. So the Fibonacci retracement tool on most charts uses four. You can put on as many as you want, as I showed you, but 23, 6, 38, 2, 50, which is not a fib number, and 61.8. Those are the crucial steps on that ladder or that assets journey. We can use them also to look at, when we put it on our charts, what would be our entry point to a trade. We've talked about it. Where would we exit a trade? Now, we haven't talked about Fibonacci extensions, but remember we talked about that 1.618, that first calculation? Well, 1.618 is called an extension because that's on the opposite side of 100. Okay, so that 1.618 would consider being an exit point. Okay, it's that extension. If you're going to enter at the 38.2, 138.2 would be your extension. If you're going to enter at 50, 150 would be your extension. Okay, that's how you might want to set your exit points. And stop losses, if I were to see 382, 50, and 71.8, okay, depends on how much I'm willing to risk and what my risk management strategy is. But I would use those and set my stop loss at slightly below the 50% retracement. That way, if that asset falls down to 50, bounces off, keeps going back up, I'm still fine. Any more than 50, I want to be out of the markets. So using the Fibonacci stop loss approach is especially interesting because it offers a more objective way to placing stops. Whereas the trader has to make decisions subjectively when to move a stop based on moving average or swing strategy. Fibonacci levels don't have this component. For that entire trade, that fib level is locked in. So once a trader has drawn his Fibonacci levels, they don't move anymore, and potential stop loss levels are well defined. In the example on the right over here, the trader drew the Fibonacci tool during the downtrend and used the retracement levels on the right to trail his stop losses. The trade exit happened once price failed to move to the next retracement level. So the easiest method is to find your next Fibonacci levels. So if you're planning to enter at 38.2, then maybe you would place your stop loss just beyond the 50%. Felt like the 50% level would hold, then you should place your stop loss past the 61.8. Simple, right? Well, they might be. They're only educated guesses. So the truth is, just like in combining the Fibonacci retracement tool with support and resistance levels, trend lines, and candlesticks to find a better entry, it would be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss. Again, they are only alerts. They're only pointers. They're only pieces of information that you should be incorporating in your whole knowledge base when you're looking at an asset. So as much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points as the basis for stop loss placement. Remember, stop loss placement isn't a sure thing. And we've talked about entry and exit points. So when you replace an exit point, it's a good idea to place it just before the level you plan to exit at. You should practice it yourself, but consider placing exit points a few points earlier than the exit level. When you're placing an exit order, it's a good idea to place it just before the level you plan to exit at, because it may not make it up to that level or through that level. So, because exiting is a trade is very, very important. Someone once told me, this is a great game out there. When you're on the sidelines, you don't have an active trade. You're just on the sidelines. You're a fan in the bleachers rooting on your team. When you've entered a trade, what have you done? You've created risk for yourself. So sitting on the sidelines, you had no risk. You had no potential profit, but you had absolutely no risk. Entering a trade is taking on risk. That's all it's doing. The minute you enter a trade, you could potentially get wiped out. The only time that you actually make profit is when you exit a trade. So your exit should be the most crucial thing you have. Too many people don't think about exit strategies. And it's important because the only time profit's made is when you exit a trade. So trying to exit at the top does not make sense because there's always a chance that there will not be another top or that one won't stop. Okay. In order to find good exit points, we must connect the Fibonacci extension levels, technical analysis, and money management. An exit plan is better than simply letting the trade run and hoping for the best. So I mentioned to you earlier the 78.6. That's like the bargain basement. Okay. There's a whole bunch of trading strategies all out there in the marketplace. In fact, I've done videos on them on how to use the 78.6 to find a bargain basement trade. So imagine yourself in a store and the salesperson saying something, all of our goods are available at 78% discount. Guess what? Buyers step up out of anywhere. Well, it might be great opportunities. You buy 3 things at 78% off. Well, hopefully one of them is going to turn into profit. But there's all kind of strategies about the 78.6. It even goes farther, but then I don't go look at it. It's the 88.6. So Fibonacci retracements are often used to identify the end of a correction or the counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. While short 23.6 retracements do occur, the 38.1 to 61.8 or the 38.1 with the 50 in the middle covers just about all the movements. The zone may seem very big, but it's just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, more confirming factors, the more robust the signal. I'm a firm believer in, like I told you, price action, but I'm a firm believer in volume. If volume doesn't support my decision, I have to go back and reevaluate my decision. So thank you very much for joining us. And hopefully the link to this class will work in about 24 hours. Now, you have to remember, it's the link you use to sign into the webinar, not the link you used if you went to investing.com and clicked through them. If you have a problem, just send a message or use a live chat button, because as far as I know, they do work. Okay. I teach hundreds of classes, and sometimes people tell me they don't work. Okay. But they usually do. Okay. So if you have a problem with it, just go on to the Alvexa website, click on the live chat, or again, I can't control any of this. It records my class. Somebody in Alvexa is going to get it in the creative department, and depending on their workload, they're going to cut it down. They're going to put an entry, they're going to put an exit, and they'll eventually upload it to YouTube. So you can go to the Alvexa YouTube site or subscribe to the Alvexa YouTube site, and you'll just get an alert when they upload it. So thank you very much for joining us tonight. I hope you learned a little or had something to think about. And no, Jack, I'm not going to do an analysis on gold at the moment. As I said to you, I do my analysis on the assets I teach from. I do not make any trading recommendations. So thank you all very much. Have a great trading night. And thanks for supporting Alvexa. Bye now.